Okie doke. So we have talked mainly about income that is earned, right? Wages. We talked about some other types of income too, like the dividends and interest income and that sort of thing, but we just kind of, those were part of another chapter. And we talked about self-employment income as well. Now we're going to move on to a different type of income that is taxed, and they are called capital gains and gains from sales of other types of property. So we have to first figure out what exactly a capital gain is and what other types of property we're talking about here. We're also moving on to a separate schedule. So remember, I said we covered Schedule A, we covered Schedule B, we just covered Schedule C, and Schedule SE. Now we're going to move on to Schedule D and another form 4797. So we've got, let's see here, 6 learning objectives in this chapter. The last one I'm just gonna pull out a couple things from that last learning objective that I want you to focus on. First thing we're gonna do is we're gonna define those terms and take a look at the tax forms that we're gonna use now, we're gonna get introduced to now. And we're gonna talk specifically about those different types of assets and their characteristics, because they are treated differently for tax purposes when we dispose of them. Their gains are treated differently, their losses are treated differently. So we've got to figure out what type of asset is it that we have disposed of, so we know what the tax treatment is. So there are 3 categories of assets. We've got ordinary assets, and think about assets, think about the balance sheet. Okay, now I do kind of want you to put your financial accounting hats on. And think about that balance sheet and the different types of assets that are on that balance sheet, right? We've got inventory is an asset on the balance sheet. Accounts receivables are an asset on the balance sheet. Equipment, intangible assets, we might have some investments as well. Those types of things are assets that we would find on that balance sheet, but they have different classifications when we sell them, depending upon how we're using them. So we're going to look at the rules for each of those types of assets. First off, ordinary assets. This one's pretty easy. We actually already covered this one in the last chapter, sort of. But it's a fairly easy concept to understand. Then we're going to talk about the sale of capital assets. Now you've heard me talk about capital gains a little bit. You've heard me mention that here and there. Capital gains occur when you sell an investment or a piece of personal property and recognize a gain from it. Okay, so you've made some sort of money on it. And there are special rules with regard to capital gains. In fact, there are a lot of rules with regards to capital gains. The reason that there are so many rules is because special types of capital gains are actually receive preferential tax treatment. They are taxed at a lower rate. Remember that dividends tax rate that we used? That's going to come back into play in this chapter because those capital gains, certain capital gains, are taxed at those special tax rates. Then we're going to talk about the sale of business assets. Business assets, pieces of equipment, vehicles, computers, anything of that nature, possibly buildings that are used in a business as well. Those items get sold, and they also have a special tax treatment that's associated with them because guess what? Those types of assets have been depreciated, right? They've received the benefit of offsetting ordinary income while we owned it through that depreciation. So we've got to talk about the rules regarding how we account for gains and losses of that type of property. Now you're going to see in here we've got a lot of numbers. Section 1221, Section 1231, Section 1245, Section 1250. These are different types of assets and they describe different types of property. And of course, with those numbers, it means that they're referring to particular sections in the tax code, okay? And then lastly, we're gonna look at some different tax rules for some special types of sales. Stock sales, where you're selling a whole bunch of stock at the same stock, but you purchased it at different times. Like you could have, maybe you invested in Microsoft and you bought 10 shares in 1991, and then you bought 40 shares in 1993, but you bought it at a different price, right? And then you bought another 50 shares in 2007, but then when you sold them all at the same time. So that's a block sale, and we've got some special calculations that have to be done with regard to that. We're going to talk about capital gain distributions and the sale of mutual funds. We're not going to talk, well, we'll talk a little bit about sale of property that's received as a gift or through inheritance. We're not really going to talk too much about the worthless securities issue there. Okay, so that's a little bit of preview of this chapter. I wish those were down low so I could actually reach them. Questions before we get started?